Today, I want to talk to you about simplifying your trading. I remember whenever I first started this whole trading thing, I was in a pretty bad situation. I couldn't really afford my bills. I was constantly stressed out about money, and I was completely ready to fix all of that. And what that created was a very desperate situation where I would constantly go into markets every single day and chase trades with no plan whatsoever. I just went out and thought I had to trade that day. I have to make money today. And doing that again caused me to chase trades, be desperate, and I soon found out that there's no way to be a profitable trader if that's the way you're trading. And I don't know how many of you are familiar with hunting. You really don't have to be to understand this analogy. Chasing trades would be like trying to chase down every deer you saw in the woods. How successful do you think you would be at hunting if you did that? Zero, right? Very, very unsuccessful. Versus hunting in the proper way, which would be sit back and wait on the perfect opportunity. And then putting yourself in that situation, how successful do you think you would be at hunting? Now, whether you like hunting or not, please understand this is just an analogy, but trading is very similar to that. If you're out here chasing trades constantly, your chances of success are going to be next to zero. Whereas if you wait for the perfect opportunity every time you place a trade, your chances of winning that trade and making money as a trader in general skyrocket compared. So today I want to teach you a very simple pullback strategy that can act as your perfect trading opportunity, your perfect opportunity, so that you're not out here chasing trades, slowly bleeding your account and possibly blowing your account altogether. This lesson will be applicable to all financial markets, stocks, crypto, and Forex. So if that sounds good, go ahead and smash that like button for me. Go ahead and subscribe if you are new, and I'll see you after the intro and disclaimer. Welcome back. And first off, I realized that I said perfect a lot in that intro. Please understand, I did not mean that this strategy is perfect and never loses. As with all strategies, this strategy has losses and wins. I was just trying to make a very clear point that chasing trades is bad and waiting for a good opportunity to present itself is a much better option. With that said, let's go ahead and dive into the content itself by going through what is a pullback first. So pullbacks are very simple. If I do this on a whiteboard, you've probably heard of pullbacks before. Pullback trading is simply waiting for price to be in trend, start creating new highs. And what we're trying to do is capture the bottom of these pullbacks as price continues in trend. But does that sound like something that's going to be easy to follow or that you're going to be able to follow at all? No, that's too simplified. We actually need to add some rules in order to create an easy way for us to stay consistent to our pullback trades, our perfect trading scenario. Again, not perfect as in it never loses, just not chasing trades and waiting for a good opportunity. So let's go ahead and discuss the rules. And before we even get started discussing the rules, understand that whenever I create strategies personally, and the best way I have found to create them is through a process I call CEST, which stands for, that's a weird T, which stands for conditions, meaning everything that needs to happen before I look for an entry. Entry, which is why did I actually press the buy or sell button, the exact reason. Stops, to control the risk, and targets, because we need to know or at least have an idea of where we're getting out if we're correct about a trade. So CEST is how I build strategies. With that being the case, let me go ahead and bring over the rules. Right before I bring over the rules though, or I'll bring over the rules while I do this, I want to show you that we actually do place trades based on a very similar strategy to this, and that will be right over here. I sent this out to the VIP members in the EAP Training Program last week. So with that being the case, let's go ahead and discuss the conditions and entries and walk through this entire strategy. So our first condition, if you'll look with me right here where it says conditions, right? Our number one condition is that we need to see 3 consecutive candles above the 50 EMA. This D stands for the daily chart. I'm a swing trader. I place 90% of my entries on the 4-hour chart. So a daily chart is what I consider my higher time frame. You can use this on lower time frames. Just have a higher time frame when you do so. So my higher time frame is the daily chart. That means I need to dive out to the daily chart. On the daily chart, I'm looking at the 50 period exponential moving average. By the way, we're going to be using the 50 EMA and the 20 EMA if you want to go ahead and plot those on your chart. What I need to see out here on the daily is that we have 3 consecutive closes. That just means 3 closes in a row above the 50 period moving average. Here we have our first, our second, and our third on this green candle. Here's my 3 consecutive closes above the 50 period EMA. With that being the case, I'm ready to start looking for trades on my lower time frame. Let's go back down to the 4 hour because that's where the rest of our conditions are going to be met. Here on the 4 hour, I need the 20 period EMA to be above the 50 EMA. This is for a bullish scenario and a bullish trade. So I need to plot back on my 20 EMA. There it is, the pink line. As you can see in this scenario, we are in fact above the 50 EMA with the 20 EMA, right? So what's my next scenario? I need price to be in trend. Obviously, we need to be making new higher highs, higher lows, higher highs. After a higher high, as you can see on our third condition, I need to see a pullback to a structure level. The structure level I'm looking at is going to be the latest level of resistance that was broken in trend. It has to be the latest level of structure that was broken in trend. So with that being the case, I have my latest level that was broken right here. This was that level. And after that level is broken, I need to see a pullback to that structure level. We get a pullback. Remember, structure levels are areas, not just lines on our chart. If I take off this black line, hopefully it'll get you to a point of understanding why this box is drawn. We kind of have a double level in here. So with that being the case, I wanted to make sure I encapsulated both levels with my zone or area of resistance that could turn to support in this trend, which I did with this specific scenario. What is the next and our final condition? The structure level must align with the 20 or 50 EMA. In this case, does the 20 EMA align with our structure level? Yes, we get a pullback to the structure level, and we're also pulling back and right up against the 20 period EMA. So with that being the case, I have the alignment I need for my 4th condition to be met. So in this case, on this specific trade, we now have all of our conditions met. Hopefully you're starting to see how much better of a situation you can create for a trade when you don't chase trades, but instead you have a very specific way that you place trades every single time. And you don't just need one strategy, but for those of you who are beginners, it's best to start with one strategy. So I want to cut in right here just for a moment and explain the logic behind all of the conditions we have. What's the logic behind condition number 1? The daily chart needing 3 consecutive candles to close above or below the 50 EMA, depending on if you're bullish or bearish. We're doing bullish right now. What this condition does is aligns us with the higher time frame trend. What's condition number 2 do? Condition number 2, 20 EMA above the 50 EMA, aligns, make sure we're aligned with the trading or the entry time frame trend. What's number 3 do? Pull back to structure levels. What we know about financial markets is that previous levels of resistance often become support in bullish trends, and the opposite's true in bearish trends. Number 4, aligning that with the 20 or the 50 EMA, those 2 moving averages are also considered areas of value. So we're combining 2 different areas of value while we're in line with our trading time frame trend and while we're in line with our higher time frame trend. That's what the power of our conditions are. So it makes it really logical. And this would be a logical way to trade anyway. But what we've done with our conditions is made this logical way of trading with the trend with pullbacks easy to follow, which is what most traders are actually missing. They understand the logic of trading pullbacks, but don't have rules that make trading pullbacks easy to follow, which is what we're trying to accomplish with CEST. Let's move on to entries. In this case, and for this strategy, we have gotten through conditions, which is the C. We're now looking for entries, which is the E in CEST. For entries, you can see that I have 4 hour buying pressure or selling pressure. We're talking about a long trade. Buying pressure can be anything from a green candle to a candlestick pattern to a price action pattern like double top, double bottom in this case. Something on an indicator that you look for like coming out of oversold. There are so many different options for buying pressure, and I'll leave that up to you on how you would like to enter into the market. Be sure you do your back testing though to ensure that it's profitable, which is something we'll go over a little later in the video. For me, I got some buying pressure out of the pound dollar coming off of the previous level of structure that aligned with the 20 period EMA. With that being the case, I now have my conditions and drew that wrong. I now have my conditions and my entry, I drew it wrong again, met. So here we go. All this is already met. Now we have to move on to our other two stages of rules in a strategy, which are the S to the T, which stand for stops and targets. For this simplistic strategy that I'm teaching you right now, we're going with 10 pips above or below the swing high or low. For a buy trade, that would mean, sorry if I'm talking fast, I've drank a lot of coffee, so maybe play this on like 0.75. But for a buy trade, that would be below our swing low by at least 10 pips. Again, this is an example strategy. You need to mold it to your own personal trading style and trading philosophy. But 10 pips below or above the swing low or high is a great place to start. So in this case, we have something like that set up here. And for targets, look for, personally, I like to look for somewhere around a 1.4 to 1, but I just put 2 to 1 based on 2 to 1 reward to risk based on the stop loss of the specific pattern. So in this case, we got out with a 2.45. I take targets a little bit differently, but in this case, that would have hit targets here on the pound dollar trade that we had last week anyway, right? So this is a bullish example of this specific pullback strategy that you can use as your opportunity to enter the market instead of just going out here and chasing trades out of desperation and thinking that you constantly have to be in a trade at all times. It's much better to have a plan beforehand that you can follow instead of going out here and chasing trades that can create a profitable situation over a long period of time. We're going to take a look at a bearish example of this to ensure that you understand the rules, but it's so important to realize that having this CEST of creating a strategy will give you one of the most important parts of trading, which is a consistent way of placing trades every time. Even if you've mastered technical analysis and you know everything there is to know about TA, you can't become profitable if you are one day trading based on support and resistance, and maybe it didn't work that day. So the next day, you just start trading every hammer candlestick you see, but it doesn't work that day. So the next day, you go and start trading based on a MACD cross or the RSI going overbought. You have to have a consistent way of trading, a consistent set of rules you trade based on. They can be based on technical analysis, but it has to be consistent to give it time to work out over a large sample size. Double tops and bottoms at major levels of structure work if you give it enough time and a large enough sample size. At least the way I trade them, it provides me with an edge over the market constantly, as long as I give it enough time to play out over a year, over let's say 100 trades. But if I was to switch from that to trading based on the RSI and other things, there's no way to become profitable if you're that inconsistent. So creating strategies based on CEST is what keeps us consistent in our trading. Hopefully that makes sense. Let's go ahead now and dive into a bearish example of this strategy. I'll see you there. Okay, so for a bearish example, we're looking here on the euro pound, and I don't feel like writing out all of the rules again, but I do know them by heart, so I'm going to walk you through every step. The first step is we want to see 3 consecutive closes. Where? Below the 50 period EMA, which is my blue line on the chart. Do we get that? Yeah, we have plenty of consecutive closes below the 50 EMA at this point, right? What's the second condition? See if you remember it. We're dropping down to the 4 hour for the way I trade. My time frames of my preferable time frames of preference. Never mind. Let me not even try to slay that one. But we're going down to a smaller time frame, and our condition here is the first thing we want to see is to make sure the 20 EMA, pink line, is below the 50 EMA, blue line. Do we get that? Yes, we do. What else do we have to do? Well, now we can see that price is moving in trend, creating lows, lower highs, and lower lows. We want to draw out an area of structure the best we can, including little periods of consolidation like this, little areas like this, and also our major level included in this entire area. That's probably going to be the most subjective and difficult part of this strategy, but all the other rules are going to make it easy, and with experience, you'll get much better at drawing these levels as well. At this point, we want a pullback that not only aligns with this level of structure we have, that price just now broke, but also that aligns with either the 20 or the 50 exponential moving average. Let's see if we get that by pushing the market forward. We're pushing up. We're now in our zone. Are we aligned with the 20 EMA? Yes, we're touching it. So that would be in alignment with our structure level and 20 EMA. We get another push higher, but we're still aligned with the 20 EMA. We get a red candle and we get a second red candle. Let's say for your entry, you decide that bearish pressure equals 2 red candles in a row. If that was the case, what would your trade look like? You'd be entering, let's say on the close of that candle, 10 pips above the swing high in this case, because this is a bearish opportunity. That would be 13 plus 10, around 23 pips. For our stop loss, we then want to see a 2-to-1 for these examples on our reward. There we have it set up. In terms of the trade itself, let's hit play and see what happens. Whew, price pushes up, gets close to our stop loss, but not close enough to stop us out, then ends up pushing down and does in fact hit our targets at a 2-to-1 reward to risk ratio. So there is a bearish example of the full strategy, just to ensure that you know the rules and you can now take them, mold them to your own personal preferences, and go attack markets with this strategy if that's something you would like to do. Now, just to show you really quickly that I do trade double tops and bottoms all the time, right here is a pound yen trade we are in, literally based on a double top at major structure. Like, there's nothing else that went into this. I do have very specific rules that I use for levels of structure and for double tops and bottoms, but we did send this trade out as well. I'll put it on the left side of the screen to EAP members. So I actually do trade based off super simple strategies, but the reason it works is because I have a very consistent way of trading these strategies that does, in fact, provide a profit over time. Let's talk a little bit about what else trading includes other than just having a strategy that makes money over time. But before we do, if you would like to start receiving what I call email analysis, which is the trades that I send out to EAP members, then there is a link in the description for that, or you can go to www.eaptrainingprogram.com. That comes with a bunch of different strategies along with my own support. It's called Priority Coaching Support. We provide support through email. Actually, it'll be me personally helping you throughout your trading journey, teaching you the basics all the way to advanced material, and providing you with email alerts like this, the Pro Trader Report, and a weekly market setups video. For those of you in the university, it is all of that is coming soon to the university as well. I just have to finish up a little more content before I feel comfortable releasing all of that in the university. Either way, both of those are in the description. If you don't want to be a part of that, it's totally fine. This is not some big drawn out sales pitch, and it will not hurt my feelings at all if you decide you do not want to join us. That's totally fine. Let's go ahead and break down what I call the triangle to trading success. So right now, after this video, you literally have the first part that you need to start making money as a trader. And that is a strategy that not only provides you a way of making money over time, as in it's profitable, it's logical, we're aligning ourselves with a higher time frame trend, we're aligning ourselves with our trading time frame trend, we're waiting for price to get to an area of value, we're using specific entries, stops, and targets. It's now not only logical, but easy to follow because we used CEST in order to create it, right? So that's the first part of becoming a successful trader, but it's by far not everything you need. You also need a risk management plan that keeps you comfortable during inevitable losing streaks that every strategy will come with. We call these drawdowns. During these drawdowns is when it becomes very, very difficult to trade your rules-based strategy. It's easy to trade this strategy when you win 5 and lose 2 and win 3 and lose 1. When you lose 8, win 2, lose 6, you're going to start really questioning whether or not this strategy is right for you. But if you did your back testing, which is not something I actually do have time to go over right now, it's just taking these rules in historic data and seeing how many times they won versus lost, and literally gathering statistic data on the strategy itself. But if you did that, it'll help you with your confidence. The second way we increase confidence and decrease fear is by having a risk management plan where we're risking a very small portion of our overall account in order to keep our emotions at bay while we go through drawdowns and while we're trading in general. The third part of anyone's trading success will be trading psychology, otherwise known as discipline. We'll put TP here for trading psychology. This is your ability to stick to your risk management plan and your strategy and your ability to handle your emotions as well. Again, backtesting and risk management will help you handle those emotions, but your understanding of trading psychology is something else that'll push you in the right direction of handling all those emotions while you're actually going in and out of drawdown and while you're making new equity highs and seeing your account go crazy to the upside and then seeing your account drop down, let's say 5, 10, or even 15% during a drawdown period, depending on your risk management plan, risk tolerance, a lot of things I don't have time to go over here on a YouTube video that I hope I kept under 20 minutes. I tried to, I promise. I know these things get a little bit long, but with that being the case, I'm going to go ahead and let you guys go. Remember the strategy rules, screenshot them, go test this for yourself. Optimize it for your own personal trading style. Make sure that you have a good risk management plan in place. Work on your trading psychology, and I promise you'll have a much better shot at becoming a profitable trader than if you do like I did when I started, go out and chase trades out of desperation. Don't worry, if that's where you are, that's where I started too. Let's get you out of that and push you towards profitable trading. To do so, make sure you're at least subscribed here if you decide not to join us in the EAP or in the university. Again, that's totally fine if you don't. Make sure you're subscribed here. Make sure to click that like button if you enjoyed the video. Comment if you made it all the way to the end. And I will talk to you in the next video. See you soon. All right, traders, so for those of you who stayed until the end, I have a special bonus for you. We actually have a possible trade setting up here on the dollar Canada. If you look with me, you can see that we've had multiple candles that have closed below the 50 EMA. We only needed we only needed 3. We have more than 3 here. So now we'll drop down to the 4-hour, bring on our 20 EMA. As you can see, our 20 EMA is below our 50 EMA, and we have a very nice level of structure looking left between our blue lines. So with that being the case, that level looks like it may in fact align with our 50 period moving average. And if it does, and we see price push up to this level in combination with our previous level of support that should become resistance, then I will be looking for selling pressure if we get that combination to push us continually in trend to the downside here on the dollar Canada. Just wanted to give you that special bonus since you stayed to the end. Again, thank you so much, and I'll see you in the next video.